welcome. Today we're talking to Feroz about the mistakes one needs to avoid while investing in mutual funds. Feroz, time and again and more often than not, you must meet a lot of clients of yours who will tell you, let's wait it out till the market's correct before we go out and invest in mutual funds. But realistically speaking, a decade from now, nobody ever remembers the entry point when they bought their first mutual fund.
Absolutely. You're correct, Samina. Quite a few people are actually in the wait of trying to see if the market falls, I would invest. But it is not a good strategy. And fortunately, if you derive all your conclusions out of data, then you're more likely to be right than wrong. Now, if you look at data of whenever the market is actually corrected, people have not had the courage to invest. Hypothetically, if there is a person waiting for a 10% fall in the market, and if it actually so happens by chance that the market fell 10%, he or she will not be able to gather courage on that day to invest. If you see all the, so we analyzed some data of the last 60 months, wherever the market has been down, the collection of mutual funds has been the least. So that is clear evidence that people who were waiting for the correction have not been able to jump in at that point in time. So month after month, when we saw out of the 60 months, there were 11 months which were a very bad month. Those months had the least collection in equity funds. So that clearly substantiates the point that waiting for a correction is futile. It is not a good exercise to indulge yourself in, because even if it so happens, if God is kind and if you get a correction, you will not have the courage to buy at that point in time, because you will then revise your objective to a further correction, which will not happen.
And most importantly, Feroz, it's not about timing the market, right? It's the time spent in the market that eventually yields you the results that you're seeking.
Absolutely, Samina, you have been propagating this point, and I'm sure investors and viewers are taking note of this. It's about the time you spent, which is very, very critical, not just the time when you enter it.
Right. Feroz, also, more often than not, we always think that you can diversify your risk by buying one too many. We sort of try to use that same sort of practice in investments as well, where we'll try and buy more than a few mutual funds, because we think, by diversification across various product lines, we might reduce our risk and, of course, yield better returns. But that, I believe, your advice is that may not be the best thing to do. Is that correct?
Correct. Investing in a large set of mutual funds statistically is incorrect. So whatever I'm going to tell you is going to be backed by some degree of homework. So statistics says that 7 to 8 equity mutual funds are the maximum you can buy. On an average, India has funds which have 56 stocks in each mutual fund. So statistically, having more than 7 funds might definitely not be a good idea. So point 1, when it comes to diversification, there is something called optimal diversification. Point 2 is all these guys are converging their money back into the same capital markets. Indian mutual funds have invested 2.38 lakh crores in 10 different stocks. So all the money is being given to converge back to similar stocks. 4.5 lakh crore out of the 8.5 lakh crore is invested in 35 stocks. So the point I'm trying to make is diversification is only an optical illusion, because all the money given is going back to similar, if not identical, stocks in the same context of Indian capital markets.
And of course, management of such a large portfolio then only becomes even more difficult to do. Also, Feroz, while we talked about how it's not very wise to wait for a correction before we invest, the flip side of that is if the markets correct substantially, most investors actually get nervous and they tend to and are bound to go out and exit and panic sell their investments. Again, not something one should be doing.
Yes, absolutely. Emotions will always give you an opposite reaction to the logical answer what you should be doing. And emotions are going to be strong in adverse movements or extensive opportunistic kind of situations. So point 1 which I'm making is, emotions are going to drive you to wrong decisions. So you'll have to be very conscious of your emotions, especially this fear emotion, which happens during market corrections. People expect mutual funds to not lose money. It is not going to happen. So these mutual funds are going to lose money if they have equity investments. And so there's no surprise. So don't make an action of an exit, because if you went in the past, now for example 2008 was a very bad year. Quite a few people quit it. Of course, it went down to as little as 35-40% of the value where it started falling from. But in 2009 May, there were 2 days when the markets gave back 30-35%. So if you went out, you would miss out on those 2 days, which could have lost a lot of value for you. Point one, don't panic. Emotions are definitely going to drive you to wrong decisions. Point two, it is said that if you look at an example of 2008 where people quit, but two days in May of 2009 after the UPA 2 came back to power, markets gave back 30-35-40% on different stocks, or even 50% on 2 days. So don't go out, you might miss out. Point three is when you have fear, you will only be able to counter it if you have done your research of what you're buying. The more you are confident about what you've bought, the lesser will emotions take over. So it's important to stay away from it. And if we analyze the newspapers when they read the worst times, actually there were good times to buy, and there is data to substantiate that. So panicking and exiting, Samina, like you highlighted, is one of the biggest mistakes a person could do in mutual fund investing.
Feroze, monitoring a portfolio daily or not monitoring it at all, both those practices are detrimental, right? You just have to be somewhere in between where you monitor your portfolio enough to ensure that you're not missing out on factors that may or may not impact your investments.
Yes, absolutely, Samina. I think an investor needs to clearly understand one thing, that the mutual funds, there's no other instrument as boring as a mutual fund could be. Anything which creates wealth is going to be boring. Like Warren Buffett had said in a quote, saying that if you're enjoying the process of investing, most likely you're not making money. So investing is going to be a boring activity. Don't monitor it every day. If you're making a systematic investment plan, at the end, if you realize after 6 months that you've made 500 rupees, it's not going to be very, very interesting to see, but it will create value in the long run. So Samina, monitoring it daily is definitely not a good idea for any investor. You plant a tree, give it the time to actually grow. You can't keep uprooting it every day to check what happened with it. Second, monitoring it very infrequently is also not a good idea. So let's give the viewers a thumb rule of what kind of monitoring is wise. In my opinion, a quarterly, a 6 monthly or a 1 yearly monitoring is a good idea to see whether you've taken off and you're flying the right course. I think the optimal frequency could be 1 year.
You know, Feroze, more often than not, we get inclined and carried away by greed. I know we're in this for the long run, but usually if you see very healthy returns or returns that are beating your expectations, most of us get carried away and are bound to book out of those investments because they've yielded us good results. Is that advisable? Would you tell your clients or our viewers that that's the right way to do it? Because if you've made your money and you've made your returns, which is beaten street expectations or your own expectations, then it's probably a good idea to check out, right, that investment. And especially because, like you said, markets are very volatile.
Absolutely. The strategy has to be different on both counts. You're absolutely bang on, Samina, when you're speaking of stocks or companies you've bought yourself. But if you've bought a mutual fund, there is already some buying and selling happening underlying in the mutual fund because there's a fund manager. So when you've bought a company, you've bought a stock and that has quadrupled, then it might just be a good idea to cash out from there and benefit from the good decision you've taken. But when you're doing it on a mutual fund, which is a basket of stocks, there is a person who's been designated to do this transaction and he is doing it or she is doing it and you're not seeing it. So you don't have to replicate the same thing which the fund manager is actually trying to do in the mutual fund. So you're right, for a direct equity investment, it makes prudent, it makes a good decision to actually profit out of your existing ones and move on to the other ones if you think that the potential is over. But in mutual fund, it's not the investor's responsibility in the first place, it is the fund manager's, and he or she would be doing it as long as you've chosen the right one.
Right. Again, when we talk about investments, we talk about, most of us usually think equity mutual funds. It's very rare, and of course, it takes a very sound investor who's assisted by a mutual fund advisor to be aware and know that debt mutual funds also make a very important aspect of a financial plan. You agree, right, Feroze?
I completely agree, especially in high interest rate economies. We might be in the top decile in terms of higher interest rates out of the 192, 195 countries we have in this world. So if that's the kind of interest rate which India is having today, maybe if you're in the top quartile in terms of interest rate not benefiting from the debt investments, today a debt fund can give you 8.5%, whereas in another emerged country it could be as little as 2, 3, 4%. So if you're getting that, you get a very good stability in the portfolio. So people ignore it, and everything revolves around, everybody has this myth that mutual fund is all about stock market and has got nothing to do with debt market, especially retail investors. They need to break that myth and give emphasis to both these assets and not just stick to equity.
And very lastly, all of this only works out if it's part of a financial plan and not ad hoc, random investments that one goes about making.
Completely agree, Samina. I think this is one pitfall most of our clients, most of our viewers would be falling into. Not having a plan is a very bad idea. You spend days to plan a holiday of 10 days or 15-day holiday. It requires 1 week of planning. Setting yourself on the journey of prudent financial management will require a plan and a goal and a context in which you will fit in the jigsaw puzzle those tiny elements which are mutual funds, your strategy and all that. So drawing up a plan is wise, because everywhere else you do so. And why this stepbrother treatment to financial planning and not having a plan? And most of them actually end up not having one.
Well, thanks for that, Feroze. Good talking today. We'll catch up with you tomorrow. Thanks a ton.